All right, why don't we get started? So thank you guys very much for joining. So my name is Mark LaMonica. I am the product manager for Morningstar Premium and morningstar.com.au. Today we're going to talk about funds, ETFs, and LICs, which hopefully should be interesting. Some of these have been in the news lately. But before we get started, we need to go through all of our housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice for our friends over in New Zealand. If you would like to get a copy of our FAP, you can go to morningstar.com.au. And if you do want personal advice, you should go to a financial advisor so they can take your personal circumstances into account. All right, so we're going to talk about funds, ETFs, and LICs today, which hopefully is exciting. I hope everybody is doing well, especially people in New South Wales, since yeah, hard to describe the situation now. But my goal for today is to not swear at all. So I apologize. I accidentally swore at the end of our last webinar. Not as bad as the other one. Peter has a comment saying looking a bit thin on top. So thank you for that, Peter. I did give myself a haircut. It was last week. Obviously not ideal, but I don't exactly know when I can go get my own another haircut. But it'll grow back, I hope. We'll find out what happens. Yeah, so my goal today is not to swear. And then my goal later in my next meeting is to try to drink an entire bottle of wine during the meeting. So it's important to keep busy during lockdown and have goals that you can accomplish. And that's what I'm trying to do. So let's go to funds, ETFs, and LICs and get started. So anyway, please ask questions as they come up. So we're going to go through some basic definitions to begin with. And then James is saying get a mobile hairdresser. I don't know what that means. Like, that means somebody comes to my house and does that? I don't think I'm supposed to do that. Anyway, any questions? Olympic swimmers swear like builders. Okay, that is true. That was, quite a scene that we saw. When was that? Yesterday? It's all blurring together. But yeah, I didn't win a gold medal, so it's, not as appropriate for me to swear. But anyway, thank you for the comments. So we're going to start with some basic definitions, and then we're going to move into, I don't know, some case studies that hopefully will be a little more fun. All right. Okay, James is saying you can have one visitor, a hairdresser. So I could start like a single bubble with a hairdresser. I will see if I can do that. I don't know where you meet hairdressers. But yeah, I'll try my best. Okay, exchange traded funds. Let's start with ETFs. So very basically, and hopefully most people know this already, but what is an exchange traded fund? Well, it is an investment fund, as you can read, that's traded on a stock exchange. You can have lots of different types of assets in it. It can be active, it can be passive. There are quote unquote low barriers to buy and sell because you can just do that through a brokerage. So that's an exchange traded fund. Trust me, we'll get into some more details. But quickly, definitional, what is a managed fund or a mutual fund if you are American like me, or half American? I don't know what I am anymore. Since I'll never go back to the US, probably shouldn't call myself American anymore. But an investment where your funds are pooled with others, and there's a professional manager that is involved. Now, a fund, very important to remember, can also be passive or active. So ETFs, funds, both can be passive or active. And then finally, maybe a little more obscure, a listed investment company. So once again, a LIC does trade on a stock exchange, but it's actually incorporated as a company. And we'll get into why that's important in a second. It is professionally managed, so these are active. And it does not, and this is important, we'll get into the details around it, it does not issue new shares or get rid of shares. So in the US, we call these closed-end funds, which I do think is probably a little bit more descriptive, but it does trade on exchange like an ETF. So we're going to get into the ramifications of all this. But first, we just wanted to be very clear that those are the definitions. These, of course, are collective investment vehicles. It means that your money is pooled with other investors, and you're investing in a certain asset class, or you're investing in a certain group of securities, whether that's picked by individuals or computers or something else, which is active, or it's just following an index, which is passive. But let's get into some of the more interesting parts and why you would decide to use one of these different instruments. All right, so we'll start, and we've also put equities on here just because we thought it would be interesting to contrast all of them. But let's go through some of the different considerations that you should think about, and then we'll get into those case studies. All right, so transaction costs. So I do want to start out, I guess, by saying that ETFs are very popular. So ETFs are widely marketed. People love them. They are, as I said, easy to buy and sell, which is why I think people like them. But that doesn't necessarily mean they are right for everybody, which I think is an important point to make. So let's first start around transaction costs. And we can talk through sort of what types of investors these would be good for. So transaction costs, what does that mean? It means how much are you actually paying for brokerage? So of course, things that trade on exchanges, you need to pay brokerage for them. Now, there are brokers that are free now, but we're assuming that you're actually paying for this brokerage. All right, so transaction costs, anything on an exchange, whether that's a share, whether that's an ETF, or that is a LIC, you are buying that using brokerage. So all brokers are different, so it depends upon what you're paying. Now, funds, you do not pay brokerage. So that means every time you transact with a fund, you're not going to face a cost. Now, a direct cost like that. What you will face, and same thing that you'll face with equities, ETFs, and LICs, is that there is, of course, a buy-sell spread. So let's talk a little bit about exchange buy-sell spreads, because that's a little more interesting, I think. So basically, a buy-sell spread is the difference between what a buyer pays and what a seller is getting for any sort of transaction. So this is underappreciated. They do add up over time. Things that influence how big the spread are is basically how liquid this underlying asset is. So that is a cost, and people need to remember that that is a cost. So if you make a round trip trade, even if you had no brokerage, you would still pay something, because there, of course, would be a difference between what you can buy something for and what you can sell something for. So just remember that that is a cost. I'm getting very strange messages now that I don't even understand. They're beyond me. All right, let's talk about management fees. So of course, all of these, well, funds, ETFs, and LICs are all issued, of course, by companies that are trying to make a profit. There are management fees. So let's talk a little bit about those management fees. These are generalities, and we have to look at every individual security. But funds generally charge slightly more for a management fee. And the reason they charge more is because of how they value and how you actually transact, which we'll get into. So generally, ETFs and LICs are less, but this is not universally true. So you do need to go in and look for and look at these individual fees, and we'll show some examples later. Valuation method. So this is hopefully where we can spend a little time talking. All right, let's talk a little bit about the net asset value. The net asset value is what all the securities that are held within these funds, ETFs, LICs are valued at. So it's very, very simple. You hold 10 different shares. At the end of the day, you look at the price of all those shares by the units you hold, multiply that together, add them all up, and you have the net asset value. So a fund, an ETF, a LIC, all have net asset values. They're all calculated the same way. It can be very easy to calculate them. It can be harder to calculate them depending upon the assets that are held there. But either way, every single day, you know what this net asset value is. So let's talk about how a fund does this. A fund will basically have a fund accountant. It's a team that values the assets in the fund every single day. So there will be a cutoff time, especially if it's a fund that's investing overseas. There'll be a cutoff time. They will value that fund. Whatever the value of the fund is what you will transact in the fund for. So if you go in and want to get out of a fund in the morning, you won't know the price. You will get the price calculated at the end of the day. Same thing if you want to go into a fund, if you want to add money to a fund. You don't know the price until the end of the day. The end of the day, when they strike that NAV, when they set that net asset value, they will tell you the price and all the transactions will flow through. So you always know exactly what you were transacting at with the fund. You may not know it. You may not know it at the time that you actually put in your order, but you're going to get that set price at the end of the day. All right, let's talk about ETFs. Same thing with ETFs. You know the net asset value, but an ETF doesn't necessarily trade at the net asset value. And let's think about this a little bit, how this works. An ETF and a LIC, they both trade on an exchange. Just like a share, price of a share is set because of supply and demand. So how many buyers are out there, how many sellers are out there, that's going to influence the price. Okay, so it's supply and demand that are setting the prices for ETFs and LICs, not the net asset value. However, for an ETF, and when ETFs were invented, they put in a mechanism to keep that net asset value and the price of the ETF relatively close together. And they do this through this, I can't think of any words now. Basically through this, through something called a creation unit. So a creation unit is simply a basket of securities that represent what's in the ETF. And investment banks can arbitrage away. They can create riskless profits, which is what arbitrage is, by exchanging creation baskets for the underlying fund and ETF, or exchanging the underlying fund or ETF for a creation basket. So let's use an example here, because this is probably a little bit confusing. So let's say there are 10, okay, let's make a very simple example. Let's say there is an ETF that has 2 different shares in it. It has CBA and NAB. So this is a 2 security ETF. Obviously, this is a simplified version of this. What this investment bank would do, what their trading desk would do, is they would sit there and they would look, and obviously there aren't traders doing this, this is all done through computers. They would sit there and look at the difference between the price of the ETF, which is getting driven around by supply and demand, and the price of adding up NAB and CBA. If the price of the ETF gets too high, so the price of the ETF is worth more than adding up the 2 underlying securities in there, what are they going to do? Well, they want that ETF. So they are going to trade the 2 underlying shares to the ETF company, who will give them a unit of the ETF. And then they'll sell that and they will make money, because there is a difference between the underlying holdings and the ETF value. Same thing if the opposite happens. So if all of a sudden the price of the ETF is below the price of the shares that are in it, they will do the exact opposite, right? They will buy the ETF, they will exchange it for the shares with the company that runs the ETF, then they'll sell those shares immediately. So they're doing all this very, very quickly, and they are making riskless profits. So that's arbitrage. Now, what this does, this mechanism, what it does is it keeps that ETF price relatively close to the net asset value. Now, there are times that it can deviate more, particularly around when markets open and when markets close. So those are terrible times to buy ETFs. You should not buy ETFs, particularly global ETFs, when markets open and when markets close. Buy them in the middle of the day. And we have lots of articles, or we have a fair amount of articles on our website, sort of talking about this, how to trade ETFs. But for the most part, ETFs are relatively close to their net asset value. And things that can influence that is timing during the day and what type of securities are in there. So in my very simple example of using NAB and CBA, those are both large cap stocks, big stocks, widely traded. It's very easy to arbitrage those. So if you invest in an ETF that has large cap, particularly domestic stocks, they will generally have a smaller, they will not fluctuate as much from the net asset value. If you're invested in something strange, where it's harder to access those underlying securities like bond ETFs, you could have a wider spread between those two. So that's an ETF. Hopefully that helped explain. I know that's a little bit of detail, but hopefully that helped explain why ETFs generally trade closer to their net asset value, and then just the type of securities that would cause that to be a wider spread. LICs, on the other hand, same thing. A LIC trades on an exchange. meaning supply and demand are going to dictate the price. There are more buyers and sellers, the price will go up. There are more sellers and buyers, the price will go down. The difference between a LIC and an ETF is there is no mechanism in place to keep that price close to the net asset value. So you can have big swings, giant premiums or discounts, depending upon the LIC. And that's just sort of the reality for LICs. So when you're looking at a LIC, you should always look at that premium or discount, spend a little time thinking about why there is one and if that could change. So you're almost looking at a couple different dimensions buying a LIC. The first thing you're looking at is, okay, who is this manager? What is the skill of the manager? Do I think they will outperform just by their security selection? Then the other thing that's going to influence your return is this discount or premium, right? So if you buy a LIC that's trading at a 10% premium, even if the manager does great and those underlying assets are growing, if it moves to a 10% discount, that's bad for you as an investor. So it's adding this other dimension. We'll talk a little bit later about why LICs, why people like them and some of the positives, but that's something that's important to remember. All right. Valuation method, sorry, we just did that one. Trading flexibility. So once again, this is why people like ETFs generally, because they're easy to trade. You trade them through your brokers. Funds are much more complicated, particularly in Australia. I will say that, when I showed up here and learned how funds work in Australia, I couldn't figure out why it's so complicated. In the US, you buy a fund through your broker. So same account, your equivalent of a ComSec account here, you just buy funds through your broker. Any fund. And they are much more reasonable in terms of minimum investment, things like that. In Australia, you have some opportunity to do that through things like M funds, which is a fund that's trading on an exchange, but mostly it's a pain to buy a fund. So you either have to fill out a bunch of paperwork and send it into the fund company, or you have to use a platform to get into funds. So funds are much more difficult in terms of transactions. You also wait a little bit to get your money, things like that. Something to think about with funds. Minimum investment. Here's the other thing. A lot of funds have pretty high minimum investments. Now, there's sometimes ways to get around there. Ways to get around it if you go through a platform where it can have a smaller minimum investment, or if you set up a savings plan, which you probably have to use a platform for anyway, or directly with the fund, where you're committing to invest a little bit each month. So that's something to think about for funds. We'll get to behavioral risk in a second because it all ties in. So this is where you need to start thinking about what type of investor are you? So, and I always think that this is interesting that, a lot of younger investors gravitate towards ETFs because, yeah, in theory, they're easy. You can just trade them through brokerage. But these are investors generally that don't have a lot of money and instead are saving and investing with each paycheck. So you do potentially have a lot of transaction costs if you're sort of continually putting money into ETFs, where funds, you can, of course, set up a system where you have a savings plan. So, if Shani were here, she could talk about her savings plan. She does that, where you're committing to invest a little bit each month, and you can get lower minimums, and then you pay no transaction fees. So every time you get paid, you can invest in funds, and you're not paying any transaction fees. So while ETFs and LICs are both, in theory, don't have minimum investments, you need to think what a practical minimum investment is, and that's based on the brokerage you pay. So while I could go execute a trade for $100 into an ETF, would I really want to do that if I'm paying $15, $10 a trade? No, right? So if I'm making those $100 trades, that's 10% of my investment in transaction fees every single time I do it. So really, ETFs and LICs, it's more about thinking about how you are actually transacting and what actually fits in with your life. And finally, let's talk about behavioral risk. So this is sort of the inverse of trading flexibility. So everyone thinks trading flexibility is great, and it is great. But at the same time, it's also probably encourages you to do it too much. So things that are easy, you do a lot. So it's the equivalent of filling your house with ice cream and then saying you don't want to eat ice cream. Well, the fact that it's all sitting there in your freezer is going to make it a lot easier for you to eat it. So maybe it'd be better if you had to have a little friction and actually walk out of your house, walk down the street, go to a store, drive to a store, buy ice cream, come back, that's probably going to make you do it less. Trading is bad. So over trading can have a huge impact on investor returns. So there is more behavioral risk. That speed bump that is put in there, basically the friction involved of actually going out there and transacting a fund, can be beneficial because it can stop you from doing something bad. Wow, we have lots of questions so far. Okay, we'll get to the questions in a second. But let's go through. Oh no, we're back to the beginning. All right, let's go through a couple more slides. Okay, so Shani did me a big favor and created these next two slides. I believe she described these bears as quote unquote cute. Those are the cute bears, which creepily do not have eyes, but we all have our own definition of what cute is. So let's talk a little bit about LICs. And we're going to do a case study on Wilson Asset Management, because Wilson Asset Management is probably sort of the leading proponent of LICs, or one of the leading issuers of LICs. So Jeff Wilson, people remember from the last election, Jeff Wilson sort of led regardless of what you think about this, he sort of led the franking credit army that he formed of investors who did not want their franking credits taken away, and were supporters of the liberals who said they were not going to take away franking credits, as opposed to Labor, who said they were going to take away franking credits. So that's sort of when, Jeff Wilson became, I guess, a little more well known. So he has created a pretty loyal group of investors of retail investors that follow him. But let's talk a little bit about some of the issues with LICs and some of the issues of some of the LICs that are issued by Wilson. All right, so first thing, let's talk a little bit about fees. Fees obviously are very, very important with any type of investment, and it's important to look at fees. And we'll look at WAM. WAM has very high fees, and they're calculated in very unfriendly ways for investors. So WAM has two sets of fees. It has a management fee, which is 1%, which is shockingly high. So everyone should, and that's not it's not an opinion of mine. 1% is shockingly high right now. So 1% a year that you pay as a management fee. They also have a performance fee. Now, a performance fee is something that came from hedge fund world. And back with hedge funds, what you always heard was 2 and 20. So basically what that means is a 2% management fee that you're paying this hedge fund 2% every year. So in Wilson's case, it's 1. And then 20 means that you are paying 20% of any outperformance. So the outperformance over a benchmark. Now, obviously, there are benefits of paying performance fees. The benefit, of course, is the manager gets compensated if they are outperforming an index. That is a good thing. I would argue if you sit there and look at WAM, in the case that they're getting paid 1%, which is, once again, shockingly high and way more than people pay on almost any ETF, most other funds, the fact that they're paying 1% is a lot of compensation. The problem with the performance fees with Wilson Asset Management, something you need to look at, is they reset every year. So a lot of hedge funds actually have performance fees that don't reset every year. And we'll talk a little bit about why, that they generally use a 5-year period, a longer term period, to measure these performance fees. So let's go through a scenario of what this means. Let's say we have a 2-year period where the ASX does not move. It is flat both years. So in year 1, let's say WAM goes down 5%. All right, so obviously it has underperformed the index. So there will be no performance fee. So you will just pay your 1%, no performance fee. Let's say it was $100, it goes down to 95, so it goes down 5%. The next year, the ASX also, once again, is flat, and WAM gets back up to 100. So it's a little more than a 5% return at this point, so it's 5.3%. And obviously has outperformed the index. So now all of a sudden you're paying a performance fee. So as an investor over this 2-year period, your investment has not moved, just like the ASX. They're both flat. But you are paying a performance fee for that quote unquote outperformance the second year because they're only looking at 1 year periods, and you get to pay 1% each year. So yeah, not great for investors. The other thing is the way that WAM is marketed. It is marketed by showing performance before expenses, fees, and taxes. Okay, that's not the performance that you're going to get as an investor. So be very, very careful when looking at marketing. And if we go back and look at WAM, even though it's pretty popular, so it is underperformed the All Ordinaries over 3 years, 5 years, and 7 year periods on the 30th of June, 2021. So it doesn't really have a great track record, but once again, it's marketing all of these fees without, or all this performance without expenses, fees, and taxes. So once again, this is just important as investors and being informed investors that we do spend time reading the small print. The other thing, of course, with LICs is they can trade at a premium or they can trade at a discount. So in this case, WAM, the 30th of June, was trading at an 18% premium. So you are paying 18% more than the assets you actually get. It's like buying a lotto ticket where, you buy a scratchy, they have enough stuff in there so that it kind of keeps you going, but you're never going to make your money back in aggregate. So yeah, something to think about. But let's talk about the good things. Shani just wrote rude. Shani's very into scratchies. She won $35 the other day, which was quite an accomplishment. But now she's eating $50 potato chips. So even with her $35 winnings, she can't afford to buy a container of potato chips that she eats. Let's talk about the good things about LICs. Peter Thornhill, who is a pretty well-known investor, loves LICs and talks a lot about them. And he also talks a lot. He's popular with once again individual investors because he talks a lot about income and investing for income, which I like and I think is interesting. He really likes LICs because of their corporate structure. Let's talk about what that means. Remember, we talked about that earlier. Let's go into a little bit of a discussion about what a corporate structure means. So a corporate structure enables LICs to retain income and capital gains and distribute them when they want. And we'll talk about what that means in a second, but that is different from something that is set up as a trust, which is a managed fund and an ETF. What a managed fund and ETF need to do is they distribute all capital gains and all earnings periodically. And all income periodically. So they cannot choose to retain that. They just have to pass it right through to the investors. And then, of course, you pay taxes on it. And a little bit later, when we talk about ETFs, we'll talk about how this can be a bad thing. So what does this enable LICs to do? It enables them to smooth distributions or dividends that you get paid out of them. So it's a whole nother dimension, and it's things the manager can do. So normally a manager of an actively managed fund or ETF is just deciding what securities go in there. A LIC manager decides what securities they're going to buy and sell, same thing, but they also get to decide how much of any income earned or capital gains are distributed out to investors. So they can smooth over that income. And people like that because if you are retired, what do you want? You want steady income. If you're trying to live off the income of your investments, you want that to be steady. 1 year you're eating caviar, the next year you're eating cat food if your income isn't smooth. So we showed a couple examples on here. So what we've got is we've got a group of LICs. And this, of course, is Shani's slide as well. Another cute bull over there. Also no eyes, like its bear friend. So if we look at LICs, here's a group of LICs. And we're looking at 2019 and 2020. And we're looking at the changes in income. Down here we have ETFs. Once again, a bunch of popular ETFs. Now, as everyone remembers from 2020, and it's like a flashback to 2020 if you walk outside now in New South Wales, as everyone should have remembered, COVID restrictions, a lot of companies suspended or cut, either temporarily or permanently, their dividends. Obviously, they were nervous about the environment they were going into. They were trying to retain cash, try to get through this, quote unquote short period of COVID related restrictions. So what happens with ETFs who have to distribute that? You see huge drops, right? So all these are around 50% drops, whereas the drops are much smaller, and in some cases there are increases across a range of LICs. So that is an advantage of LICs. So if you are a retiree and you are living, obviously you have to trust management. So that's part of assessing the manager and sort of what their attitudes are towards income and what they're going to do. But if you're a retiree who is living off of dividends that come out of your LIC, well, your year is looking a lot better here than if you are invested in ETFs and you have to live off of that income. So this is the cat food category. And here, yeah, you can probably still eat your caviar, right? So that's why Peter Thornhill really likes them. And that's why they're very popular, especially with retirees. So something to consider. And that another dimension to active management is actually figuring out what are we going to distribute from that income and capital gains. All right, we have lots of questions, but let's get through a couple more slides. This is a slide I put together, which is, not as cute, I guess, but you can let me know. All right, we want to look at index ETFs. So first, I went to Money Smart. So, the government and all, telling us what is good about ETFs. So they list 4 different things that are the advantages of investing in an ETF. Diversification. So of course, as we talk about, you get this basket of securities. So you're able to be widely diversified in one trade, as opposed to if I want to build a portfolio of individual stocks, or even more difficult, individual bonds, I need to buy a bunch of them if I want to be diversified. So that's an advantage to an ETF. So transparency, of course, you know what this net asset value is. So that's obviously a good thing. They're low cost, all right? So they have low expenses. So you're getting diversification, you're getting it pretty cheaply. Once again, easy to trade, that same thing. But we're going through this Dr. Jekyll and Mr. Hyde look at what has happened to ETFs. Originally, I wanted to use Frankenstein in this, but I couldn't think of like the good side of Frankenstein. And I wanted to use Frankenstein because a lot of these quote unquote indexes that ETFs are tracking are Frankenstein indexes, but we will get into that. Okay, so let's look at some of these ETFs, and I promise I'll spend lots of time with questions. Let's look at some of these ETFs. So here are some top-rated, gold and silver rated ETFs by Morningstar. So obviously our ratings. So these are our top ratings. And I wanted to use a couple different companies. So iShares, that's BlackRock. I did put in 2 Vanguards, and then Van Eck. So let's talk about these and put them through this, this diversification and low cost viewpoint. Okay, so if we talk about diversification, we'll start with VTS. So VTS looks at the US stock market, the entire investable US stock market. So that's large cap stocks, mid cap stocks, small cap stocks, everything. So if we go and look at VTS, there are 3,891 holdings in VTS. So a lot. Which is a good thing. So you're getting diversified. You're getting a lot of diversification from it. So that's good. We look at MVW, 105 holdings. So MVW is a Van Eck Australian equal weight ETF. So in this case, rather than a market cap weighted ETF, we're looking at equal weights of everything in there, meaning the biggest of the 100 companies is going to be in the ETF as the same proportion as the smallest of the 100 companies. So 105 holdings, 11% of that is in the top 10. So obviously skews a little bit before they rebalance, but you basically know what you're getting in the top 10 because it's equal weighted. We look at VISM. So VISM, so Vanguard International small cap ETF. So we're looking at small cap stocks around the world. It has 4,245 holdings. Only 2% of the assets are in the top 10 holdings. So that's developed market, small caps. And then finally, we'll go over to the fixed interest side, IAF, 516 holdings. These are Aussie investment grade bonds in here. 20%, 27% are in the top holdings, which is a lot. Top 10 holdings, which is a lot. But at the same time, these are basically government bonds at the end of the day. So not a terrible thing. All right, what are you paying for these? VTS, you are paying 0.03 for a fee, which is shockingly low. So that is 3 basis points. So if you want like weird finance jargon, 100 basis points are in a percent. So when you hear all of these ridiculous finance types talking about basis points, 3 basis points. When 100 is in a percent, you're paying basically nothing for that. 35 basis points, a little higher fee for this Van Eck, Australian equal shares. 30 basis points for this small cap Vanguard fund, and then 15 basis points for these bond funds. So very, very low fees. So once again, when we compare those to the 1%, that Wilson Asset Management is charging, the most expensive, this Van Eck Aussie equal weight is, roughly a third of the fees with no performance fees. But then we go over to this side. And for anyone who listened to our podcast on, the thematic ETF rant, that's what we're going to talk about now. So ETFs started out doing all these things. Generally, they were passive. There are active ETFs now. They were following these large indexes. You got instant diversification. You didn't pay very much. Well, we've had this explosion of thematic ETFs. So basically what a thematic ETF is, for people who have not listened to the podcast rant, thematic ETF is, in my view, a marketing invention by an ETF company to take advantage of some sort of fad that's happening. So while these are quote unquote passive ETFs that are following an index, they are these Frankenstein indexes that have been put together specifically to target people that are into these fads. So let's go through a couple of these and we'll put them through the same test, this diversification and fee test. So we can start with the one that I think is most ridiculous, this FANG Plus ETF. And actually, I did this on the podcast as well. I went to the website and got some of the language that's used around this because, in my opinion, it's almost laughable. All right, so it follows something called the New York Stock Exchange FANG Plus Index. And that index tracks, and I quote, the performance of highly traded growth stocks of technology and tech-enabled companies in the technology, media, and communications and consumer discretionary sectors. All right, so if you don't understand what that means, it's probably because they designed it that way. But if we break this down a little bit, the performance of highly traded growth stocks. So what does that mean? It means popular stocks. What's traded a lot? Stuff that's popular. All right. And then they've got this sort of technology and tech-enabled companies because they wanted to put technology in there because everyone's into technology. But I don't know what a tech-enabled company means. If you can go out and find me a company right now that does not use technology in some way, then yeah, I would be shocked. So next time you walk in somewhere and somebody is writing out on a scribe, on a giant piece of paper, their transactions, like let me know. We can find that non-tech enabled company. And then of course they have a bunch of different sectors. So tech, media, communications, consumer discretionary. So basically at the end of the day, they can do whatever they want. There is no real criteria. And turns out there's a committee of people that pick stuff that go into this FANG Plus index. And guess how many securities are in there? 10. So this ETF has 10 holdings. You pay 35 basis points, which actually isn't that high compared to some of the other ones for FANG. So yeah, something good. I won't go through the rest of these in detail since nobody wants to hear my rant, but we have the BetaShares Global Robotics and Artificial Intelligence ETF. Because right, robotics and artificial intelligence, like it's basically the Terminator ETF, that if this thing becomes self-aware, it will take over the world. And we'll be battling these ETFs and COVID at the same time. So this is 57 basis points. So that's more than 0.5% that you're paying for that. Is 29 holdings, 73% of that whole ETF are in the top 10 holdings. We've got Asia. So Asia invests in Asian securities, Asian tech securities. So most is allocated to China. Also expensive at same thing, 57 basis points. ACDC, which I also think is ridiculous. So that's looking at battery technology, although most of the companies in there make only a small portion of their money from battery technology. You're paying 69 basis points for that. You're paying a lot of money for these tech ETFs. So just be careful that all ETFs are not the same. And I think one of the biggest problems with these is a lot of them, if you go and look at the underlying companies don't necessarily represent that theme. So even if you think that this theme is something you should invest in, um, yeah, you're not really getting exposure to that. And I think, this ACDC is a good one, just because I know this one a little better. That, with this battery technology. So if you look at the top holdings, they are automakers. Samsung's in there. Now, Samsung makes battery technology, but Samsung doesn't make most of their money does not come from battery technology, right? Like, it's like going to McDonald's and investing in McDonald's stock because they sell fruit. Yeah, they technically sell fruit, but most of their money comes from selling cheeseburgers. So same type of thing. It's the problem with a lot of these thematics. And what they basically do is they set criteria that are, so low for companies to be included in that, that you can have these companies that, yeah, make batteries, but has nothing to do with their overall business. So obviously, that's just my opinion. But just be careful. The point is, be careful that a lot of people invest in ETFs because they go through and they look at these checklists and say, these are all great things. These are all things I want to do. I want to be a passive investor. I don't want an active manager. And then they invest in these crazy indexes, which are these strange amalgamations where I guess technically you're still a passive investor, but not really, not in any sense of what passive was designed. If you went and did a seance and contacted John Bogle, who ran Vanguard, he would not consider these passive. He is sort of the prophet of index investing. I don't think he would consider any of these passive. All right, rant over. We've got lots of questions, so let's get to the questions. Hopefully, most of them are not about my haircut. Okay, so Hugh is asking, is the market maker's role to anchor an ETF to its NAV? So why will it deviate? Yeah, basically, that is a role that's being played with these arbitrage, with trying to generate arbitrage or risk-free profit. The issue is, of course, there is friction involved in this. So even though these are computers doing it, even though trading costs are very, very low, particularly for institutional investors, there is still some friction involved. So you will still see deviations from NAV, but it won't be anything crazy. And particularly at certain times during the day. So while these market makers, basically the investment banks that are the trading desk are doing this arbitrage, while they're quote unquote waking up and figuring out exactly what they're doing, that's when you can see those larger deviations. So that's why we suggest you wait a little later in the day to trade an ETF. So hopefully that answered your question, Hugh. Okay, so we've got a question from Ron. So he's talking about that he was charged fees of between 1% and 3% on managed funds some years ago. Does this still occur? So basically, financial advisors used to charge commissions on funds, and so that has gone away. So financial advisors are not allowed to charge commissions anymore, except I think on life insurance still. But anyway, yeah, no, that has gone away. So that obviously is a very, sorry, just turned on my computer. That is a very large fee that you'd be paying up front. All right, so we've got an anonymous attendee. I can go to our website, hopefully, and answer this question for you. So this anonymous attendee is asking, does Morningstar show you if a ETF is trading at a discount or a discount or a premium to NAV? So I personally wouldn't go to Morningstar to do this if you are trading. I'll show you what we have. I would go on to whatever trading platform you're using, because what they'll give you is real-time data. So I'm going to share my screen. All right, so here's this ACDC, my second favorite. I'm saying this facetiously, my second favorite thematic ETF. So right here, you've got a premium. So this thing is trading at a slight premium, but this is for the close. So what we're looking at is the last close. So what I would do is instead use your trading platform, which should be able to show you a real-time discount or premium over NAV. So hopefully that answers your question, anonymous attendee. Oh, somebody said you're going too fast. I apologize. And says to recap LICs. So if you have a specific question on LICs, please let me know. I'm sorry that I went too fast. I would say that I have exciting plans later, but we know that's not true. So my fault. I'll try to slow this down. Let's see, what else do we have? Okay, let's talk a little bit about dividends. So we do have, or distributions. So we do have a question from George. So George is asking, yeah, a couple different questions, but I do want to touch, I'll try to get to the other ones as well, but I do want to touch on distributions. Okay, so funds and ETFs both distribute, they distribute capital gains and income. So what that means is basically if there is a capital gain event, and let's talk about sort of a traditional ETF. So if an ETF needs to buy or sell a security, and there is capital gains involved, meaning they bought the security for lower, sold it for higher, and they will then distribute that to you. Now, the reason this occurs generally with an ETF is around rebalancing. So if something's rebalanced, they would have to do that. If something comes in and out of the index, they would have to do that. Now, for traditional ETFs, this doesn't happen all that much. You do still get it. But particularly for these thematic ETFs, there will be a lot of rebalancing. So an example is this ridiculous FANG ETF that has 10 holdings in it. So what they do is they rebalance quarterly. So what does that mean? They have equal weight between 10 different holdings. So every quarter they sell all the winners and then they buy the losers. Now those losers still may have had positive gains. All of the gains could be negative, but whatever has more than 10% allocation, they will sell, and then they'll buy the stuff that has less of an allocation to get it back to 10%, 10 securities, 10% in each one of those. The problem with this is that if the markets are doing well, like they have been, particularly a lot of these tech stocks that are in FANG, which has done very well from a performance perspective, they are selling winners that have performed very, very well. They're selling them after only a quarter when they're rebalancing. So you're getting all those capital gains. So I'm on a lot of these investing message boards, and people have been really excited when they start to get their distributions from things like FANG. And everyone's like, oh my God, we're making so much income. And I'm like, no, you're not. You are going to be in trouble when your tax bill comes. This is not income. So if you are a retiree, or you think you can live, if you're one of these FIRE people who think you can live off of this income, so that's financially independent, retire early. If you think you're living off the income from these ETFs, it's not real income, right? It's capital gains that they're giving to you. It's not dividends that are getting paid by the underlying stocks. And the trouble that people get into is when markets are going well, those distributions are going to be higher because the capital gains component's higher. Then when markets do poorly, those distributions are going to disappear. So people that are invested in these ETFs and think that this is income, just like with a share that's paying you dividends, it's very different because that component's made up of two different things. So Lisa is back. So Lisa did not attend on Tuesday because she went to lunch. I told her I was very jealous since I just eat by myself here, at least today. And so Lisa said, can you elaborate on the description of a platform for buying funds? Yeah, so basically a platform, originally platforms went through financial advisors. So an advisor would be signed up for a platform. The platform would basically have a series of funds that advisor would then put clients into. Now, platforms, there are some retail platforms now. So like CFS has one, Perpetual has one. Shawnee were here, she could talk more about platforms and perpetual. She used to work there and uses a perpetual platform. So basically, it's just a bunch of funds that are on there that you can access through the platform. So that's the way that you access them, and they take care of a lot of the tax and reporting and everything else for you. The fees are generally different for funds on a platform. They can be higher or lower depending upon the platform. There are some, I think the perpetual platform that Shani uses, I think there are some advantages because you can basically swap in and out of funds without actually having a taxable event happen, which is good for you because you're actually invested in the platform. So there are positives like that. So you won't actually have to pay taxes, so you take money out of the platform. So anyway, platforms I think are not as popular as well, a lot of different ways to invest, but yeah, they're still out there. Okay, so the anonymous attendee asked a question: can you lose all of your investments through funds, ETFs, or LICs due to bad or fraudulent management? Yeah, no, at the end of the day. So, can there be some, well, I'm just going to say no. So basically what happens is, let's take a fund for example. So with a fund, the manager never gets your money. So the way that funds and ETFs and LICs and everything else works is there's a custodian bank that actually controls all the money. So this is probably a little bit obscure, but basically the way this works is the bank controls all the funds. The fund manager decides what goes into or out of, what investments the fund is going to make. So they will execute a trade. And if this gets a little wonky, let me know. They'll execute a trade. They'll basically execute a trade either on a chat or over the phone. And they will say, okay, I will buy your CBA shares for X amount of dollars. That then flows to the custodian. The custodian and the other custodian that holds the money will match those trades, and they exchange dollars for shares. So as the custodian, they're responsible for keeping the money and keeping the shares. So the fund manager never has it. So the fund manager can't touch any of that money. Now, what everyone always says to this is what happened with Bernie Madoff. Bernie Madoff was not a fund, and he was not an ETF. He sat outside of this structure. So for regulated funds and ETFs and things that are available for the average investor, they can never touch your money. Are there some, and a lot of this stuff has been cleaned up, are there hedge funds where they actually held it, which is what Bernie Madoff had? Yes, exactly. That's how he committed fraud, because the money was actually sent to Bernie Madoff. It was not sent to the custodian. So you have all these independent, if you're a fund, you have all these independent entities, a custodian, you have a fund accountant, which is independent, which is calculating and valuing that so that the fund manager can't value it. There's all these safeguards in place. So the answer is basically no. So yeah, hopefully that helps. Yeah, so Sarah's asking, do you pay a management fee on a LIC if you buy through a broker on the ASX? Yes. So basically what they're going to do is they're just going to take that fee out of the money that's already in there. So once again, like if we have this whole custodian, the custodian holds all the underlying securities. They will bill the custodian will pay out of your funds. Basically, that's how they're going to take their 1% fee. So that will be accrued. If we think about how the net asset value is calculated, it will be accrued every day. So you're never going to see a 1% hit come out of that, where the NAV drops by 1%. But they'll use accrual accounting. So a little bit comes out every day, and then at some point, they'll pay the fee and the accrual goes away. So for those people that are into accounting, that's how that works. So yeah, accrual accounting. Okay, so Mim has a really good question oh, we have two good questions. Well, we have lots of good questions. So Mim is saying, so Magellan ETFs charge above 100%. Is that justified given they get a good rating from Morningstar? Yeah, so we rate Magellan very well. So, the underlying funds, we have gold ratings on it. I think it's silver on the ETFs. But yeah, Magellan's expensive. So I'd put them in the same category without the performance fee as WAM, right? So you are paying oftentimes around 1%, a little over 1% for Magellan funds. Now, our managers, and I will say we do take fees is a huge component of the way that we rate funds and ETFs. In that case, our manager research team thinks that that Magellan's ability to outperform the market over the long term makes up for that fee. But yeah, I would say, for a Morningstar rating, it's unusual that something that gets a fee that high, that has a fee that high, does receive that good of a rating. But it's a good comment. All right, so Hugh is making a statement, which is true. So he says, don't forget, if you're retired, like me, you don't pay any capital gains tax. So yeah, I'm obviously looking at a taxable event in a account where you're paying tax. Yes, there are obviously accounts, superannuation, where you're not actually paying that. So yeah, all of this is based on your own particular situations, but that's a really good reminder, Hugh. Lisa's saying, is the case study montage a Sydney Sider before and after lockdown? Yeah, the Dr. Jekyll, Mr. Hyde thing. Yeah, potentially. That, yeah, we'll see what I look like after this thing is over. It's not going well. So maybe this is my low. Maybe when my hair grows back, we'll be happier. Okay, so Justin is asking, how do you tell the difference between a factor ETF and a thematic ETF? Okay, really, really good question. So, a thematic ETF. So let's talk about what a factor ETF. A factor is if you are investing, basically, if we are creating an index based on a certain factor. So I would say the difference between a factor and a thematic ETF, and they're similar. A factor ETF could be, we are investing in an index that quality. So quality denoted by certain things. So quality could be denoted, there's a Morningstar Moat ETF that Van Eck has, where they're investing in companies that our analysts give a narrow or wide moat rating to. So that's an example of a factor ETF. Qual is the ticker symbol, is another factor ETF that's looking at quality securities, and they have a number of different criteria. So, the way I would portray that is it is different than a thematic ETF because it has not been created, in my mind, by a marketing company trying to get access, or a marketing department trying to get access to battery technology. Batteries are not a factor. A factor is something when we look at fundamentals around investing. A factor is value or growth. We invest in a growth ETF or a value ETF. We are not trying to pick companies that fall into a certain theme that resonates with the public. We are looking at the underlying attributes of the security and creating an ETF. So I know that sounds probably pretty similar, but sort of the difference is the indexes that have been created around like battery technology. So this AC/DC thing, the battery technology index, is looking at companies that produce lithium, which is an ingredient in batteries, a raw material that goes into batteries, and then looking at companies that produce batteries. And they've sort of pushed this thing together. Their battery definition is you have to produce enough battery power to basically have the equivalent of, I believe, storing enough electricity to power 300 homes. I mean, that's tiny at the end of the day. So that's what I would say would be the difference. Wow, we have a lot of questions and we're out of time. Jeez. So maybe, Shani, if you could just capture some of the questions. If anyone has questions, you can just send them directly to my email. I'm sorry that I didn't get to them all. It's mark.lamonica1@morningstar.com. And I promise I will get back to you in the next day or two. And yeah, apologies that I did not get to the questions. I didn't think we were going to have that many. I should have gone faster at the beginning, but then I got told I was going too fast. So whoever said that, if you want me to reiterate anything, just let me know. All right, so I'll be back on Tuesday with how to make better investing decisions. So we'll look at some of the behavioral sides of investing. But thank you guys very much for joining. And once again, I'm sorry that I didn't get to all the questions.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.